So in this video we will be practicing a question related to disposal of non-current assets. Let's begin. The question says a business depreciates its plant at the rate of 25% per annum, reducing balance method for each month of ownership. Okay, so we have the rate, we know the method, and we know the policy, and that is monthly basis policy. Very good. Details are as follows. Okay, so the business purchased a machinery costing 2600 on 1st of January in 2016, then in the same year on 1st October, then no purchases in 2017, another purchase in 2018 amounting to 2800 on 1st of September, and then what is happening in 2019, sold machinery which had been bought for 2600, right? So this one which was purchased on 1st January 2016 for the sum of 810. What is this? This is the disposal proceeds. I am receiving 810 against this sale of non-current asset, and this was sold on 31st of August 2019. So this is the disposal date. The requirement is to prepare machinery account, provision for depreciation account of machinery, machinery disposal account, okay, very good, and statement of financial position extract for each of these years. Okay, so first of all, let's prepare the machinery cost account, right? First year is year 2016, there is no brought down. So the purchases in 2016, 2600 on 1st of January. Very good. So January 1st, 2600. Then there is another purchase on 1st of October amounting to 2100. October 1st, 2100, right? No more purchases. This means that we now just have to extract the balance. So balance carried down will be 2600 plus 2100, 4700. That is the total as well. Now let's move to another year, year 2017. First of all, we'll write the balance brought down, right? So are there any purchases in 2017? No, nothing is happening in 2017. So we know what we have to do. We'll just write the same figure as the balance carried down on the last date, right? So we are done with 2017 as well. Now let's move to 2018. January 1st, balance brought down. Now what is happening in 2018? We are again purchasing an asset on 1st of September amounting to 2800. Right, now just the balance carried down figure, and that will be 7500. Now let's move to year 2019. This is the year in which there is a disposal. So let's first write down the balance brought down, 7500, right? If there had been any more purchases of non-current assets of machinery, we would have debited it. But what is happening in 2019? We are selling a machinery which had a cost of 2600. Okay, so we know that what is the double entry to remove the cost of non-current asset from the non-current asset cost account? We debit the disposal account with the cost. Okay, and in this case this will be 2600, and then we will credit the machinery cost account with the same figure. Please don't make this mistake that you credit your non-current asset account with the disposal proceeds. No, this will be entered in the cash account or in the bank account, whatever you are, in whatever form you are receiving it, right? But in order to remove the cost from the non-current asset account, we credit the non-current asset account with the cost of the machinery that is now being disposed of. So this is happening on 1st of August, right? 31st August. Okay, so 31st of August disposal, amounting to 2600, right? This is this machinery which was purchased on 1st of January, the first one. Now after crediting the disposal, now we will calculate the balance carried down figure, and that will be 7500 less 2600, okay, which will be 4900. Now let's just total it. 7500, 7500. One last thing that we should also do is extract the balance for the next year. January 1st, balance brought down 4900, right? In previous year it was 7500, but since now you have sold an asset, so it has decreased to 4900. Okay, so this is how we have prepared our non-current asset cost account, right? Now let's move to our next account, which is provision for depreciation account, and this is going to be really interesting. So the first year is year 2016. There is no balance brought down, so we know that there will be just two entries in this year. For December 31st, there will be the income statement entry, that is the current year depreciation charge, and on the same date the balance carried down figure, which will be same in this year because we don't have the balance brought down. Okay, so let's calculate depreciation for year 2016. Alright, so this is my working area. We know that how many types of machineries are there in this question? Three machineries, right? So machinery 1, machinery 2 and machinery 3. So first year 2016, I am purchasing machinery 1, which had a cost of 2600, right? Now in order to charge depreciation on this asset, what was the policy? Let's recall the policy. The policy is reducing balance method for each month of ownership at the rate 25%, right? So since this is being purchased on the first date of the financial year, so for how many months we will charge depreciation on this asset? For full 12 months, right? And the next one is being purchased on October, so 3 months only, October, November, December, right? So let's first charge depreciation on the first asset. 25% multiplied by 2600 would give me a depreciation of 650, right? And let's write down the cost of machinery number 2 as well, that was 2100. And for how many months will I now charge depreciation on this asset? 25% multiplied by the cost for 3 months only, so 3 divided by 12, and that would be 131.25. Let's just make it 131. Now let's calculate the net book values for the year ended 31st December 2016, and that will be 1950 for machinery 1 and 1969 for machinery number 2. So what figure will I take as my current year depreciation figure in the provision for depreciation account? 650 and 131, right? So 650 plus 131 will give me a figure of 781, and that is my current year depreciation charge, and this is the same figure for the balance carried down as well. Now let's move to the next year, year 2017. First we will write the balance brought down. So balance brought down is 781. Then the same entries will be there, that is one for income statement and the next one for balance carried down. Now what is the situation in year 2017? There are no new purchases, we just have these two old assets. So on the first one we will charge depreciation for full 12 months because this remained in the business for full 12 months in the next year as well, and for the second one as well we will charge the depreciation for full 12 months, right? Previously, since we are following the monthly basis policy, so previously we just charged for 3 months, but now for full 12 months we will charge depreciation on both of these assets using of course the reducing balance method. So year 2017 depreciation on machinery number 1 on net book value, okay, not on cost, 1950 multiplied by 25%, and for machinery number 2 it will be 1969 multiplied by 25%. So for machinery 1 that would be 487.5, let's make it 488, and for machinery number 2 it will be 492.25, so 492 is fine. These will give me net book values of 1462 for machinery 1 and 1477. Okay, so although when we are following the reducing balance method, we know that the depreciation every year decreases, but in this case it is not decreasing, right? Rather it is increasing. In first year it was 131, now it is 492, but this is only because we charged for 3 months only in the first year, and for the next year we are charging for full 12 months. Only that is why. Okay, so what is the depreciation charge in the current year on these two assets? 488 and 492. With these two amounts, I will debit my income statement and I will credit my provision for depreciation account, and the total of these two will be 980. Right, so 980 plus 781 will give me a balance CD figure of 1761. Okay, let's move to year 2018 now. January 1st, balance brought down. Now it is 1761. Again, the same entries will be there in this year as well for income statement and for the accumulated depreciation balance carried down. So now what is happening in 2018? We have these two assets, right? Machinery 1, machinery 2. We are again purchasing a new one on September 1st. This means that how many months for depreciation? September, October, November, December. 4 months now. This is being purchased at a cost of 2800. Okay, so let's first calculate depreciation on the old ones. Okay, so depreciation on machinery 1, again on the net book value. So 1462 multiplied by 25%. For machinery number 2, it will be on 1477 multiplied by 25%. Right? So for machinery 1, it will be 365.5, 366, and for machinery 2, it will be 369.25. So let's just keep it as 369. Right? Now, what is the cost of machinery number 3? It is 2800. Right? In the third column, of course, 2800. So now depreciation will be in this case it will be on the cost first year multiplied by 25%, and for how many months? For just 4 months. So 4 multiplied by 4 divided by 12, that will give me a depreciation of 4 months only, 233.33. so let's just keep it 233. Now the net book values for machinery 1, it will be 1096, for second it will be 1108, and for the third one it will be 2567. Right? So now what amount will go in the income statement for current year depreciation? 366, 369 and 233 for these three machineries, and that would be 968. Okay, so 968. Then this means that my balance carried down, that is my accumulated depreciation, will be 2729. Okay, this is my total as well, 2729. Now we are standing in the year 2019. We know that something new is happening in this year, the disposal, of course. So balance brought down is 2729. Then there will be, of course, the current year depreciation charge, no change to that. But on the debit side, now there will be two entries other than the accumulated depreciation figure. Okay, so now this disposal is happening on 31st of August, but since we are following the monthly basis policy, this means that we have to charge depreciation on this asset which is being disposed of for first 8 months, right? January, February, March till August. So first 8 months of depreciation will be charged on this asset as well, along with the two assets, machinery number 2 and 3. Right? So what will be the situation now in the year of disposal, that is year 2019? On machinery number 1, this is the same machinery which is now being disposed of. So no more depreciation on 12 months, rather, since it is being disposed of on 31st of August, just for 8 months. That will be 1096 multiplied by 25% multiplied by 8 divided by 12 months. This will give me a depreciation of 182.67. So let's just make it 183. Now on machinery number 2, the net book value was 11108 multiplied by 25% for full 12 months. It will be 277. Then on machinery number 3, now in this year, for full 12 months, so 2567 multiplied by 25%, that would be 641.75. So it will be 642. So these three, 183, 277 and 642, will go in my in my income statement for the current year depreciation. Right? How much? 183 plus 277 plus 642, and that would be 1102. This is my current year depreciation charge. Okay, so income statement debited with this figure and my provision for depreciation account credited with the same figure as well, 1102. Now we learned in the previous video that we have to remove two things. First one was the cost, and we have removed the cost. Right here we removed the cost. Now second thing that we also have to remove is the accumulated depreciation on the asset that is now being disposed of. So we have to remove that as well. And what was the double entry for that? We used to credit the disposal account and we used to debit the provision for depreciation account with the figures accumulated depreciation. Right? So how do we calculate the accumulated depreciation? Very easy. We just have to add all the depreciation that we have charged so far from 2016 till 2019 on machinery number 1. So let's calculate that as well. Accumulated depreciation on machinery 1 will be, in the first year it was 650. So 650 plus in 2018 it was 488. Add 488. Then in 2018, right? So 2017 488. In 2018 it is 366. And then in this year it is 183. Right? It has reduced because we know we have charged for only 8 months. So this is my accumulated depreciation on this asset. The total of it will be 1687. So now I will debit my provision for depreciation account with 1687, and I'll credit this the same figure in my disposal account. Right? So 1687 disposal. Now we will calculate the balance carried down figure. That will be 2729 plus 1102. The total of this will be 3831. Same total over here as well. And after the subtraction of 1687, my balance CD figure will be 2144. Right? This is the current year accumulated depreciation. It has reduced. Why? Because we have subtracted the accumulated depreciation on this asset which is being disposed of. So one last thing that you must do is to extract the balance brought down for the next year. So for year 2020 it will be now 2144. So this is how you prepare the provision for depreciation account if there is a disposal of non-current asset in the question. So we are done with how many requirements? We are done with first one, we are done with the second one as well. Let's do the third one, that is disposal account. Okay, so disposal account is over here. Now this disposal is happening on what date? On August of 31st. Right, year was 2019, August 31st. First of all, we removed the cost. And how did we do that? We credited the cost account. So this means that we now have to debit the disposal account. So machinery, and the cost of this was 2600. Then secondly, what did we remove? We also removed the accumulated depreciation from the provision for depreciation account. right? And what was the accumulated depreciation? 1687. So we debited this in the provision for depreciation account, so this means that we have to credit it in the disposal account. Now what else is entered in the disposal account? We know the format, right? Let me just quickly show you the format. So this is the format of the disposal account. We credit the amount being received as well. So how much have we received? We received 810 against this disposal. Let's assume it was received in cash. So bank or cash would be debited and disposal account will be credited, right? So now what do you think? Is there a profit on disposal or is there a loss on disposal? The total of 1687 and 810 is 2497. So this means that there is a shortfall on the credit side. This means that there is a loss on disposal, right? And what is the figure of the loss? The loss figure is 2600 less these two values would be 103. What was the net book value of this asset at the time of disposal? Can we calculate that? Of course we can. Cost less the accumulated depreciation, the net book value will be 913. This was the net book value, but however I am receiving only 810. So less 810 means I am incurring a loss of 103. I am receiving 103 less than the net book value of this asset, right? Now if the value I am receiving was more than this value, that is 913, there would have been a profit. But if the value that I am receiving is the same as the net book value, then what do you think would be the result? There would have been no profit and no loss on such transaction, right? So there will be no income statement entry on either of these two sides. Now we are done with the third requirement as well. Now we are just left with the last one, and that was to prepare the SOFP extract. So let's do that as well. So here is the format which you can follow if you have to make the extract for multiple years. We write the years in this way, and we write the information of machinery, its depreciation in the net book value in the vertical, right? So what was the cost? We know that we just have to look at the balances carried down now. So what was the balance CD figure in first year, that is 2016? It was 4700, right? So let's write that down, 4700. Let's first just write down all the costs, right? So we are done with this one. The balance CD figure for year 2017 is again 4700, the same cost. Then 2018 it is 7500 because we purchased another asset, so 7500, and then in the last year it is 4900 because we disposed of an asset, so it is now 4900. Then the accumulated depreciations, again the balance CD figures on the debit side. For first year it will be 781, so less 781. Then for the next year it is 1761. Then for the third year it is 2729, and then in the last year it is 2144. Okay, so if you follow this format, it is really easy and time saving to calculate the net book values for multiple years. So the net book values for 2016, for 2017, for 2018 and for 2019 are these values. We know what we have to do. We just have to take the balances carried down figures for cost as well as for provision for depreciation account, and then we'll have our net book values. Okay, so this was an example in which we covered everything. We prepared the cost account, we charged depreciation using monthly basis policy and with reducing balance method. We made the double entries, we prepared the full depreciation account in which there was a disposal accumulated depreciation, there were purchases in this question in multiple years. So this was a good example. In the next video, we'll again be solving an example which was a bit different than this one, right? This was a pretty straightforward example. So I'll see you in the next video.